Tesla just reported $3.93 billion in operating cash flow, but basic stock market analysis is completely misreading the real story. Behind this headline hides a structural pivot masked by quiet shareholder dilution. Are you funding a highly profitable traditional automaker or an unprecedented technology experiment? When total gross margin measuring revenue left after direct production costs surges by 478 basis points to reach 21.1%, you naturally assume pricing power has returned. You see operating cash flow hit $3.93 billion this quarter, and standard analysis suggests this is a robust cash engine. However, diving into the footnotes reveals that stock-based compensation reached an astonishing $1.03 billion. This massive expense actively subsidizes that original $3.93 billion cash metric. This burn rate is masked by share dilution, and this $1.03 billion dilution figure is something you can easily verify. To grasp this financial illusion, look at the glaring gap between two critical metrics. While total gross margin sits comfortably at 21.1%, operating margin remains violently pinned at a razor-thin 4.2%. Operating margin shows what is actually left after paying all business costs, making this massive gap incredibly concerning. Why does this harsh 4.2% reality exist right now? It happens because hard-won manufacturing savings are instantly devoured by soaring robotics expenses. The company is intentionally sacrificing current profitability to fund this 4.2% margin transition phase, shifting focus away from traditional manufacturing. This structural observation brings us to a staggering $2 billion in operating cash diverted directly into SpaceX equity. Management aggressively frames this $2 billion capital pivot as a strategic technology partnership. You are no longer evaluating a vehicle manufacturer, you are financing a $44.7 billion multi-entity conglomerate. You might willingly accept this altered structural risk profile if core automotive demand was flawless, but crowded factory lots tell a completely different story. Global vehicle inventory days of supply climbed 23%, landing dangerously at 27 days overall. This physical stockpile pushed nominal inventory to an alarming $14.4 billion, proving that global production outstrips showroom purchases. Fortunately, the services and other segment revenue surged 42% year over year to hit $3.74 billion. It practically proves that physical hardware sales face significant demand friction, while recurring ecosystem revenue provides a much-needed $3.74 billion financial cushion. For example, energy generation and storage revenue unexpectedly contracted by 12% year over year. Deployed storage volume dropped significantly to 8.8 gigawatt hours, briefly stalling the decentralized energy narrative. Despite this segment contraction, total liquidity stands at an unmatched $44.7 billion across the balance sheet. This fortress balance sheet is further supported by an ultra-conservative debt-to-equity ratio of just 11%. This specific ratio measures financial leverage, meaning the company strategically uses very little borrowed money to operate. This massive $44.7 billion liquidity pool provides the strategic flexibility to outspend any rival on autonomous infrastructure. Unsupervised robotaxi miles reportedly surged 100% quarter over quarter, signaling a critical transition in consumer product adoption. If the autonomous segment fails to effectively scale, the massive research expenditures constantly suppressing that 4.2% operating margin will have been entirely for nothing. So, what do the core numbers say about the upcoming Q1 2026 earnings projections today? The underlying data conclusively proves the company is systematically winding down its historical identity as a highly profitable automaker. The famous $44.7 billion liquidity pool is no longer shielding a cyclical car business. It is aggressively financing a highly dilutive, capital-intensive pivot directly toward artificial intelligence infrastructure. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.